Good evening, viewers. Welcome to the webinar on IRB InvIT IPO. So we have our in-house expert, Mr. Deepak Jasani. He is the head of retail research in HDFC Securities, and he will be taking you through the nitty-gritties of the IPO. So we have a list of exhaustive questions actually, and we have made this webinar very detailed. So by the end of it, hopefully you will not have any questions in your mind that will be still left unanswered. So on that, welcome sir to the webinar.
Good evening to all.
Yeah, so we'll start off with the most basic and the obvious one. So what are the issue of the term?
Yeah, so this IRB InvIT IPO is a unique instrument which is being introduced for the first time in India. So all compliments to the regulator and to the companies who are involved in launching of this IPO. Now the basic issue terms, let me go through quickly. The issue opens between May 3 and May 5. The price band is 100 to 102. The face value is 100. Now these are all units, these are not shares. So let us be very clear, units of the trust or trust fund. So 100 to 102 is the price band. Typically, if one is serious about getting allotment, then they should apply at 102. So their chances of getting allotment are slightly better. Here there is no system of cutoff, unlike the normal public issue. The issue size is rupees 4,300 crores, which is equivalent to 42.16 crore units. And in addition, there is an offer for sale by the sponsor, that is IRB Infra, of 3.47 crore units, totaling about 45.63 crore units. Plus, there is an option to retain 25% oversubscription. In our view, the maximum oversubscription which can be accepted would be around 3.85 crore units. So totally, the whole issue size will amount to about 49.48 crores units in case the issue is heavily oversubscribed and the issuers opt to retain the oversubscription. Now, this is necessary so that the sponsor, that is IRB Infra, maintains 15% stake. So, taking this into account, we felt that oversubscription only to a certain extent may be accepted. Now, the QIB portion in this issue is 75%, unlike the normal IPOs where it is 50%. Now, this includes 60% which is allocated to the anchor investors. Now, yesterday we got a notice from the company, from IRB Infra Private Limited, who are the investment managers, saying that they have allotted units to the anchor investors, now worth rupees 2,094.5 crores. Now this has been allotted mainly to pension funds, long only funds, sovereign funds, etc. Only 16% of the anchor investor book has gone to the domestic institutional investors. The mutual funds and FIIs will pay either no tax or lower tax on whatever income they receive from the fund. FIIs are subjected to 5% withholding tax on the interest income which is passed over from the trust to them. To that extent, there is a tax liability involved for the FIIs. So, net this instrument has the potential of being very attractive to these kind of investors. Non-institutional portion is 25%. Now, these investors, which include retail or HNI or private corporate or whichever else, now these investors will pay applicable income tax on the interest which is passed over to them. So if you are in the full tax bracket, which hopefully everyone will be looking at the minimum application size, then you will pay a full tax on your interest income, but on buybacks and dividends which the trust will conduct, there will be no tax liability. The bid size, the minimum bid size is 10,000 units and in multiples of 5,000 units. The trading lot after listing is such number of units that exceed 5 lakh rupees as the exchange may specify. And the sponsor of the issue is IRB Infra Developers Limited and the investment manager is IRB Infra Private Limited.
So how will the proceeds be utilized?
The initial issue size is 4,300 crores. Out of this, about 4,200 crores which are borrowed by the road SPVs. from the lenders, including the IRB group, will be repaid. So basically, the debt which is lying on the books of SPV will be substituted by debt from the InvIT fund. Now, this debt will be lent by the fund to the SPV at 13% per annum, so that the SPVs have enough tax set off in their books as and when they become profitable, and the trust has enough interest to redistribute among the unit holders.
Okay, thank you, sir. So one of the lingering questions at the back of our investors' mind will always be about the background of the sponsor. So requesting you to throw some light on it.
Yeah, now here the sponsor is IRB Infra Developers, which is a listed company. It is one of the largest infra development and construction companies in terms of net worth in the roads and highway space, according to NHAI's annual pre-qualification list for 2016. Now, excluding these 6 road projects which are being transferred to InvIT IT, the IRB Infra Developers has 16 other road projects, out of which 8 are operational, 5 are under construction, and 3 are under development. Now, if we go to the look at some data or details about these 6 road SPVs, they are spread across various states of the country. The first one is Surat Dahisar, the second one is Tumkur Chitradurga, third one is Bharuch Surat, the next one is Jaipur Deoli, the next one is Omalur Salem Namakkal, and the last one is Talegaon Amravati. Now these 6 road SPVs have 1250 crores of revenue in FY16, and the average residual life or the life of the concession that each one enjoys is about 12 years. For the 9 months of the current year, that is FY17, these SPVs have incurred a loss of 13.05 crores after interest and depreciation. However, this loss has reduced as compared to the previous years. In FY16, this loss was about 76.6 crores, and in FY15 it was 123.8 crores. So these SPVs are close to becoming break-even and then maybe going profitable. Now, for making assumptions on the revenue growth for these SPVs, the sponsor has used practical assumptions of about 5.5% traffic growth and 4.5% toll WPI. Now, every year the toll will increase based on a formula which is based on WPI. So these are slightly conservative estimates which have been made by the sponsor. Now, as per the offer document, the fair enterprise value of these 6 road SPVs is about 7,051 crores. The InvIT Trust also has the right of first offer and first refusal for any to access future and existing assets which are developed or acquired by the sponsor group. So going into future, whenever IRB Infra wishes to divest its road assets, this InvIT Trust will have the first right of offer as well as refusal.
Okay, so thank you so much. So the next question would be about the strengths of the InvIT Trust and the strategies that are to be adopted by them. So if you can go through the various strategies and the strengths that they have.
Yeah. Before that, let me also look at or talk about the estimates of fair enterprise value which has been worked out. The 6 road SPVs have been valued on a fair enterprise value at 7,051 crores by the sponsor in the RHP. However, the fund is being launched at an enterprise value of 5,924 crores, which is a 16% discount to the fair enterprise value. So leaving something on the table for the investors. At this valuation of 5,924 crores, the fund offers an IRR of 12.4 to 12.5% depending on the withholding tax, and a yield of about 10 to 11% in the initial years. Yeah, now coming to your question about key strengths of the InvIT and the strategies to be adopted by them. Now, the key strengths of this trust is it has a portfolio of income generating assets in key growth markets. So as I discussed, the 6 road assets are in growing markets or growing states of the country. It has a diversified road project portfolio and a revenue base. It is an experienced sponsor, investment manager and project manager with consistent track records in operating and maintaining projects in roads and highway sector in India. We talked about how IRB comes in the top companies in the NHAI list. It has low leverage upon listing, providing debt capacity to finance future growth. It has an experienced management team with industry experience. It has growth opportunities and access to sponsors portfolio. We also talked about the right of first offer and first refusal. It is in an attractive sector with strong underlying fundamentals. Roads and highways in a country like India are going to see further and further usage, growth in traffic, etc., etc. It also has a CARE AAA rating for borrowings up to 1000 crores. So this limit can be used by the fund to borrow funds at about 8.5% and lend it to at 13% to the SPVs. Again, enhancing the surplus which is distributable to its investors.
Thank you. So what are the investment strategies and risk and capital management strategy?
Now, the fund, as per the RHP, wants to go for organic growth through proactive management. It wants to do acquisition of toll road projects, and it wants to optimize its capital structure. These are broadly the investment strategy and the capital management strategy.
Okay. And so what will be the distribution policy of the trust?
Now, in accordance with the InvIT regulations and the applicable guidelines, which are issued from time to time by the SEBI, each project SPV shall distribute at least 90% of its respective net distributable cash flow to the trust, not less than once in every 6 months, and such distribution shall not be paid later than 15 days from date of their distribution. In turn, the trust shall distribute 90% of the net distributable cash flows to the unit holders, not less than once in every 6 months. But we have been told that the fund is looking to distribute once every quarter. So that may be more often distribution for the investors.
So thank you. So now, from the investor perspective, I guess this is one of the very important questions which is coming up is about the risk. And so, would you like to throw some light on the risk related to the business and the structure of the trust?
Sure. Now, the offer and the trust carry certain risks. So let us go through those risks one after the other. The debt which the fund will give to the SPVs comprises of certain unsecured loans. So security may be an issue, but typically in such infra projects, security is difficult to enforce and to take lien on. The regulatory framework governing the infrastructure investment trust in India is yet untested, and the interpretation and enforcement thereof involves certain uncertainties, because this is the first issue on the block. People are yet to sort of get familiar with how things will shape up and how the regulatory framework will start working going forward. The trust may not be able to distribute any income to the unit holders in case the amount received from the SPVs may fall. But this is not very likely because interest, unless the SPVs at their level see a very drastic fall in their revenues. The project SPV's toll concession agreement may be terminated prematurely under certain circumstances by the NHAI or by the government. But even in those circumstances, the project SPV is entitled to termination payments or such other payments from NHAI in accordance with the agreement which it has entered into originally. The next risk, which is more practical, is the road SPVs may see decline in traffic volumes, which will materially affect their revenue and their growth in revenues. Now, however, over FY14 to 16, the 6 road SPVs have seen a traffic growth of about 9.4% CAGR. The next risk is the newly constructed or existing alternate routes may compete with the initial road assets and result in diversion of vehicular traffic, resulting in reduction in revenue in the road SPVs. So this is again another risk which is practical, may work out in some cases, but as the trust has will have investment in 6 road projects. In each road project, this risk sort of arising is not to such a great extent. Changes in the government policies is another major risk because a lot of the framework is sort of set up on based on existing government policies. In case the trust fails to make acquisitions in future, then the growth going forward may get hampered or impacted because some of the SPVs may reach their end of their concession life in the next 4 or 5 years. So they have to be replaced by new assets. The project SPVs as concessions are illiquid in the sense that it may not be very easy to get rid of them or to sell them off in case of such an eventuality arises. Changes in the tax structure also may impact the overall structure and the income of the unit holders. This include the deductions under Section 80 IA for the SPV's road assets also.
So what is your take on the tax implications at various levels?
Yeah, so now here interestingly we will have to look at the tax implication at the 3 levels. One is the SPV level, the other is at the InvIT level, and third is the unit holder level. At the SPV level, the interest on loans from InvIT are not subject to withholding or TDS. So the entire thing, entire interest will have to be paid out by the SPV to the InvIT trust. Distribution of dividend by the SPV to the trust is not subject to dividend distribution tax in case the InvIT trust holds 100% of the stake in the SPV. As far as the IRB InvIT trust is concerned, in only in one case it has 75% stake, and the rest it has 100% stake. In the case 74%. In case of Omalur Salem Namakkal, it has 74% stake. So in the rest of the SPVs, no dividend distribution tax will be applicable when the SPV declares dividend to the InvIT trust. Now coming to the InvIT trust, whenever as far as the income of the trust is concerned, dividend and interest received by the InvIT trust from the SPV is tax exempt, so no tax is applicable. Capital gains that the trust earns on disposal of assets is taxable in the hands of the InvIT trust, and any other income that the InvIT trust earns is taxable at the maximum marginal rate. Now, interest component which is passed over or distributed by the InvIT to the unit holders, now they would attract 5% withholding tax in case the receiver is an FII and 10% in the case of resident holders. Now coming to the unit holders, interest income which the unit holder receives will be taxable in the hands of the unit holders as if they have received the interest directly from the SPV. Now this is taxable at the applicable rates to the resident holders, and as far as FIIs are concerned or non-resident offshore investors are concerned, it is taxable at the rate of 5%, subject to the DTA regulations. Dividend income that the unit holder receives from the InvIT trust is exempt in the hands of unit holders. Sale of listed units of the InvIT trust on the exchange will attract STT on par with the listed equity shares. Now, when the unit holder sells the units in the secondary market, in case of short-term capital gains tax, it would be wherever the STT has been paid, it will be chargeable at 15%. In case and short-term here means anything less than 36 months. In case of long-term capital gains, that is, if your holding period is more than 36 months, it will be chargeable at, it will be tax exempt. Now, if it is an off-market transaction, of course, it will be taxable at 20% in case of LTCG and 30 and as applicable rates in case of short-term capital gains. So these are broadly the tax implications of the at various levels.
I guess so. So now we have a outlook question, like where we can say that, how good are the projections of InvIT over the next few years? So what would be your views on it?
Yeah, now the fund and the sponsors have given some sort of projections in the RHP, as per which the income, the net income of the InvIT Trust will remain stable in the range of 265 to 300 crores over the next 3 years, FY18 to FY20. But here what is more important is the cash flow, because the distribution that is made is out of the cash flow. Now, even the cash flow projections have been given by the trust and the sponsors, as per which the trust will have a distributable cash flow of between 588 to 658 crores per year over FY18 to FY20. So, based on a enterprise value of about 6,000 crores, it would work out anywhere between 9.8% to about 11% in terms of yield.
So which other companies are eyeing this kind of issues?
Yeah, so a lot of infra companies want to reduce leverage on their books and are waiting for the response to this IPO. Reliance Infra is one. Then apart from that, India Grid, Sterlite Power Grid, ILFS Transportation and MEP Infra are some other companies which are looking to follow a similar route going forward.
Okay, sir. So what will be volatility in prices of these units post-listing?
Yeah, basically what will drive volatility in the prices post-listing. Now, immediately after listing, people will try to get uh, those units which they wanted but could not get as allotment. So let us forget about the first 15 days. But beyond the first 15 days, the listed or the traded price of these units will depend on the interest rate movements in the system. So basically, whenever interest rates will go up, the prices of these units may reduce and vice versa, because the buyers of these units typically want to buy them to earn near fixed kind of returns. So that is how this interest rates in the system will be a key driver of the traded price on the exchange.
So what about liquidity about these stocks post-listing?
Yeah, unlike a regular stock, retail investors or retail traders are not allowed to participate in the even in the secondary market, because the trading lot size is a big 5 lakh rupees. So initially, immediately on listing, these units will have a lot of liquidity because the intending buyers who have failed to got adequate allotment will come and buy, whereas some others will come to sell. However, later on, the liquidity in this counter will be in spurts. Basically, it will not be uniform. We will see high volume and high liquidity on certain days where there is a big buyer on the counter or a big seller on the counter. On other days, we may see average kind of a volume.
So then, going to your view? So what would be your views on this particular IPO?
See, it is a good beginning. It is a new instrument. Indians are getting taste of different kind of financial structured instruments. So in that sense, as a new instrument, it is a good beginning. We are not talking about whether you should subscribe or not subscribe to this IPO. We are talking generally about this kind of units. Now, this is despite the fact that the regulatory framework governing these kind of trust is yet untested, and the interpretation and enforcement thereof may involve certain uncertainties. But at the same time, the kind of near fixed returns that it is not exactly promising, but which it is trying to offer, will have a lot of willing buyers, especially from the foreign institutional side. And even some of the local large HNIs. Now, this kind of instruments will also help large capex or large debt carrying companies, infra companies, to deleverage their balance sheets and also give investors a chance to earn near fixed returns, as we discussed. it provides investment opportunity in infrastructure to a larger pool of investors and financial institutions, which both domestic as well as global. It will also aid in reducing the exposure of the Indian banking system to the infrastructure segment. As we all know, the banks are facing some stress from certain infrastructure kind of projects. Such IPOs may be a precursor to more investment infrastructure trust and later on real estate investment trusts. And real estate investment trust abroad are a very big product and have consistently given returns on par with equity or better than equity over longer periods. So we will look forward to introduction of such instruments also going forward.
Thank you, sir. So the next question is a very important question, especially from the investor's point of view. And so basically, what we are looking at the key factors, that an investor should be particularly aware of before investing.
Now we will have a series of IPOs from these kind of instruments. The success of these InvIT IPOs would largely depend on the investor sentiments towards the long duration and moderate return arrangement. So whether how excited or not excited they are about these. Now in these kind of InvITs, the class of investors which are attracted are different from the regular IPO kind of investors. And these kind of investors generally would want a regular fixed kind of cash flow with some volatility up and down. So investors should also, while applying in such IPOs, look at the ability of the trust to provide an attractive yield in an environment of interest rate volatility. They should also be aware that issuers may face challenges time and again in obtaining premium valuations for their assets, which would depend on a lot of things like the sponsor's credibility, the experience of the sponsor, the quality and revenue generation ability of the underlying assets, the government policies, etc. They should also be aware of the fact that InvIT will be exposed to specific sectors that may be undergoing their own business cycles. So you will have to be aware and cognizant of the business cycle of that particular sector. So investors net would do well to recognize the downside risk also in terms of valuation of their investment due to the above factors playing out negatively. So a near fixed kind of a return or a quasi capital kind of a instrument is attractive, but please be aware of what can go wrong. It is not necessary that it will go wrong every time, but you should be prepared for that kind of an eventuality and continuously monitor the environment to look for signals, such signals, so that you can take appropriate exit at times.
Great point, sir. So now, what this IRB InvIT IPO, what makes it very different from the rest of the IPOs that we have?
Yeah, so basically these IPOs, InvIT IPOs, will attract different kind of investors from a regular IPO. Here the interest will be more from institutions and from long-term focused HNIs who wish to earn near fixed kind of a return from a quasi-capital kind of an instrument. Here the tax implications are also very important. This will attract a lot of HNIs whenever the interest rates are on the downturn. This kind of instruments will be in fancy or in demand. Typically people will compare these kind of instruments with the tax-free bonds which are available on the exchanges, whose yield currently is about 6.4%, 6.5%. Now, if whatever is sort of offered or assured in this kind of IPOs proves out to be true, then the HNIs may end up earning 8.5 or 9% post-tax return, which is where the 200 basis point difference is quite huge in that sense. The second point is the upside and the downside, or the trading range of an InvIT IPO will be far more narrower than a regular stock. In a regular stock, we may see a very sharp up move post listing or a sharp down move also. Here, the range will be quite narrow, so you have to sort of bring down your expectation about the earning phenomenal returns out of this, The larger ticket size in terms of trading lot also has its own implication in terms of limited but mature future participation in the secondary markets.
Thanks, sir. So thank you, sir, for a very detailed walkthrough of this IPO. But before we conclude the webinar, is there anything that you want to share with our viewers about this particular IPO?
See, we mentioned that we are not allowed to advise subscribing or not subscribing to this issue. This was mainly to create awareness about such kind of instruments and this particular IPO. Indian investors have got one more kind of instrument to invest in. They will do well to track the issue and its post-listing behavior, so that going forward they can take a call as to whether they would like to invest in such IPOs in future. They would also do well to know as to why the market gives a particular valuation to a particular InvIT, and what are the key monitorables that the investors should look forward to in future.
Thank you very much, sir, for your time. With this, we conclude our webinar on IRB InvIT IPO.
I hope we have been able to sort of bring some awareness and some knowledge to everyone who is watching this show.
Absolutely, sir. So we have discussed in details about the strengths, the strategies, the risks, and we have also shared that what are the key factors that one should be looking out before investing. Repeating sir's sentiment that we honestly hope that we have brought in a lot of things on your table to help you make that investing decision. So we'll sign off for today. Till the next time, this is Navneil and this is Deepak Jasani from Retail Research. Thank you very much for your time.
Thank you for joining us.